whole life insurance, of all things, does some really cool things related to self-banking and tax strategy. So I'll explain this quickly. I'll try to keep this brief, but there are at least 4 reasons why I was compelled to add whole life insurance to my own personal portfolio. And for some of our clients, it also makes great sense. So in the first, and I'll put this into TGIF just to make it real simple for all of us.
You found the Real Estate Law Podcast, because real estate is more than just pretty pictures, and law goes well beyond the paperwork and courtroom arguments. If you're a real estate professional or looking to build real estate expertise, then welcome to the conversation and discover more at realestatelawpodcast.com.
Welcome to another episode of the Real Estate Law Podcast. I really appreciate your, once again, downloading this or choosing to listen to it. It means a lot to all of us. I'm Jason Muth, and here with attorney broker Rory Gill from Next Home Titletown Real Estate and Urban Village Legal in Boston. Howdy.
Hey, Jason, how are you?
I'm excellent. And we're here with a special guest today. We're really excited to have Mark Willis on. Mark Willis is a certified financial planner, and he is a bank on yourself professional based out in Chicago. And Mark, I have to tell you that you have the privilege of a children's room as the background for where we're recording this. And I both apologize and am excited to make this episode unique. And we'll explain why I'm sitting here in a second. But you just showed me a drawing from your daughter, is it, or your son?
Yeah, my daughter brought this in right when you and I were talking about your background. So, no apology necessary. I mean, what are we doing this all for, if not for our kids? And it's a privilege to have the chance to work from home when possible. So what a gift. Yeah. And what a cool background. I asked you at first if it was virtual. It was so well lined out. All the little, we have a live in front of a studio audience here today, Jason. Yeah. So thank you.
These are legitimate. These move around. That's Luke right there.
Okay, cool.
Next on Titletown.
All those nice stuffed animals there.
Downstairs in our daughter's bedroom while she is outside watching Frozen in, excellent parenting that we're all doing during the pandemic, which is basically do whatever you can. And yeah, she's home from daycare today. So I thought that starting Frozen before we record this, coming into her bedroom to record it would allow it to be the quietest quietest environment for me and maybe least distracting, but it's very possible we're going to have 2 children on this podcast, both from our end and your end.
That's right. We're going to find out at the same time. So keep listening, audience, to find out.
So Mark is also a podcast host himself. Mark has the Not Your Average Financial podcast, and he has well over 200 episodes already recorded. And it's definitely worth a listen. Very well done. Excellent show notes. You're an excellent host yourself. It's almost like you went to school for speech or oration or whatever the word is, because I found your voice very soothing as I was listening. So you have to tell us a little bit about yourself. Tell us about the Not Your Average Financial podcast. Tell us about, what you're up to these days, how you're navigating through these uncertain times that we're all in. And then we'll jump into the conversation.
Well, I'll answer maybe the last question first. How are we navigating uncertain times? You do it scared is one way to do it. Do it scared and that's how we started our podcast. We did it scared back in 2017. We didn't know what a podcast really was or what it was like or what it would do. But what I realized was our firm was growing in such a way that we were meeting people all across the country. And I was having one-on-one conversations with folks over Zoom and over the phone, even pre-pandemic. And the same themes of conversations were coming up over and over again. People having questions about, Mark, am I saving enough for the future? Should I pay off my debt or should I invest? Am I paying too much in taxes for how much money I make? These same themes were happening over and over and over again. So we really thought maybe a podcast or something like it would be able to give clarity, at least from our perspective, give some clarity to a very unsettled world. And even in 2017, when we started our podcast, there was a lot of unsettledness. Volatility hasn't stopped since we started the podcast. In fact, turbulence and volatility seems to have only increased in the subsequent years. And even now today, who knows what the end of 2022 will bring us. Here's hoping some more fun parties for our little kids and a little more freedom in that regard. But it's definitely a question of what will happen to your finances, what will happen to your future. How do we take some manner of control in a time that feels so out of control?
So if I do the math correctly, if you have a 5-year-old, it sounds like you started this podcast around the same time as becoming a dad.
That's right. Yeah. Well done. Yeah. So we take things at least in twos, sometimes threes. I think we also moved our offices that same year, and we just, why do things one at a time, for sure.
Just do them all
Yeah.
at the same time. Yeah. Well,
That's
credit
right.
to you for being a couple hundred episodes in. We started shortly before our daughter came into our lives, and boy, that knocked us for a loop. It's a challenge. Do you have one child or multiple?
Yeah. One and only.
One and only, yeah, us too. And your life changes. It's so cliche, but everything that you can think about that you used to remember is no longer.
Yeah. One person once said he was trying to describe the brand new world that you're existing in as a parent. He was trying to explain this to young college kids at the time, and he didn't know quite how to describe it. But what he said was, hey, college kids, try to explain like sexual attraction to a 3-year-old or something. Right now you might be buddy with your neighbor down the street, and it might just be, totally a little kid relationship. But someday you might grow up and have a brand new lens on which you see your relationship. And he kind of likened that to what it's like to become a parent. I'd be curious your thoughts. Maybe this is a topic for another podcast, but it struck me as kind of accurate that there's almost a brand new lens by which you see everything else. It's almost like you enter into a brand new room in your heart. And in your mind, and what you earn, what you spend, what you how you engage the world around you, it all changes sort of. Maybe I'm putting too fine a point on it here, but parenting does have a sort of transformative experience for at least some folks that I've, in my own experience anyway.
Rory, what do you think there?
I mean, it changes the reason why you do everything that you do, from earning money to organizing your life to keeping yourself healthy. Everything, the purpose and the reason changes, and it's not forced upon you, but it's just something that you feel. And that does change overnight in a way that you don't necessarily expect. And perhaps I like your analogy where, it's a change of different perspective and understanding. But for me, the why changed for almost everything.
There you go. Yeah. Well, hey, who knew we'd be talking about this on a real estate law podcast? But I'm glad we are, because this is really underneath all the money and all the rates of return and the withdrawal rates and the market volatility and the cap rates. This is what we're doing it for, at least hopefully for many of your listeners.
Well, I could actually hear her outside the door right now wandering around. So she might actually make an appearance on this podcast. But why don't we do this first? Since the Y is knocking on the door right now. Mark, why don't you tell us a little bit about, how you got started with this, like, how you ended up in this space right now, maybe even like through a different lens of the parenting, how it changes. And she's able to open the door now.
Yeah, sure. I can roll with it. All right. Hi there.
You're making a special guest. Okay.
Totally beautiful. Hi. She must be about 2, 3, maybe 3 or 4. Or
she will be 3 in May. Yeah.
Gonna be 3 soon. Oh, wow. Cool. The 3-nager. Okay.
The 3-nager. I'm going to go on mute right now while you chat a little bit.
Sure. Okay. So I'll tell a bit about our personal background. So I graduated, my wife and I met, and we got married in college, and we graduated together with 3 private school degrees between us and 6 figures of student loan debt. We graduated from my graduate school days in 2008. So we finished all the education. We were ready to meet the world, and it was 2008. And so we graduated with really not really a very marketable degrees between us, and nobody was really hiring, and the world was coming to a global standstill. And we had 6 figures of student loan debt, and a lady named Sally Mae who seemed to want to move in with us for a monthly payment every single month. That was a shocker and an eye-opener for sure. And it brought me really face-to-face for the first time with this thing called money, something I'd never really paid much attention to in previous years. And so I had to take a hard look at what is money, how does it work? I didn't know a thing about it. I kind of stumbled into student loan debt, like so many of us do. Whether it's you stumble into most things in your life. I feel like many of our clients, it's the same thing, guys. You kind of stumble into your student loans. You might stumble into a couple credit cards. You might get your first W-2 job and stumble into a 401k. And all of these, it's almost like you're collecting these rocks. The rock of your 401k, the rock of your student loan, the rock of your credit cards. And you don't exactly remember. Maybe you got a little cryptocurrency. Maybe you got a Roth IRA at one point. Maybe you have a rental property even. And you've just been adding all of these accounts into your backpack, almost like, this bag of rocks. And at first you're like, yeah, I'm carrying them with you, but then it starts to weigh you down. It starts to lower your ability to respond creatively and dynamically. And over time, you just have this big old bag of rocks, and it's not really meeting your objectives, and you don't remember why you have these rocks. My daughter, she collects a bunch of these special rocks. And at one point, we all knew where they came from and they had a special story. But now there's just a big old bag of rocks in her bedroom, So does that really mean anything anymore? And I feel like most people's financial life, it's the same. And that's how it was for me. So in any case, we had to find a way to live free. We wanted that. And so we got serious about our personal financial life. We found strategies to help us pay off our debt, to invest in real estate, to start our business, to invest in other businesses. Since become so convinced that it matters that we started the firm Lake Growth Financial Services to share our strategies that we've learned. One blind beggar finding bread and sharing it with somebody else. We're trying to get the word out. So that's what we're up to these days.
No, I mean, I love that. And that resonates. I think you probably read off my life financial story. I escaped college relatively well, but left law school with a tremendous amount of student loan debt. And when I emerged, that student loan debt stood in the way of what really were the goals. That the reason for going to law school was to kind of open up opportunities in my life. And I looked at what I left law school with in a recession in 2011 and saw that the student loan debt defeated the entire purpose of kind of going there and studying in the first place. And it's been a struggle. And I don't know, when you and your wife pivoted from having the student loan debt and kind of, honestly, the emotion that goes behind it, creates a panic, which can be motivating, but it also, to me, I felt the conflicting emotion of kind of being defeated and being demotivated by the debt that was behind me. So how did you just address it mentally before we get into the actual strategies of financial growth?
We wanted to emphasize, we have a prevailing philosophy that I don't want to just be a tennis ball floating down the gutter of life, right? I don't want to just be acted upon and be beat up by the world's circumstances. I try to avoid the word victim or deserve as much as I possibly can in my personal life. I just feel like it yields a better life when possible. Obviously there's things that happen to us outside of our control. Somebody once said, Mark, you cannot control as much as you think you can, but you can influence more than you think you can. And I feel like that's a good threading the needle a little bit there. So for us, yeah, it was an emotional decision, determination that we were going to take a step toward influencing our future, to having some better version of our future than we wanted our present or our past to have. And there's a great quote by Dan Sullivan. He says, always make your future bigger than your past. And so that decision, that commitment, that orientation toward like a bigger future was what really got us centered on and focused on knocking out that debt. And more importantly, having a game plan and actually having an outcome-based financial life rather than just reacting toward the bag of rocks that was just being given to us one by one by one. We wanted to be able to say, all right, what do we truly want our money doing for us? Rather than our money telling us what to do, we wanted to have our money doing things that we wanted it to do. And we literally did. We wrote down a list of characteristics and attributes. Like we took all the labels off: real estate, savings account, 401k, annuities, hedge funds, Bitcoin. There was no real Bitcoin at that time, but you get the picture. We were removing the labels from money and saying instead, what are the perfect, like if we could design our own perfect financial vehicle, if we could make a financial life custom designed with what we want, what sort of attributes, what sort of characteristics would we want it to have? What sort of functions do we want our money to have? And then we'll get around to finding the right ones. And in fact, after we did that exercise, that's kind of what started me down the pathway of looking into the certified financial planner designation, because it gives you the full gamut. It was a personal discovery journey as much as it was a training for serving our clients. But when you get your CFP, it's like for me anyway, it was like a 3+ year deep dive into this thing called money and all the ins and outs of tax law, estate planning, insurance, investments, technical analysis, fundamentals. It was wonderful. And it gave me, I guess, a confirmation of what we wanted our money doing for us. But that was the key starting point. If your listeners get nothing else from this episode, I'd say take 5-10 minutes, just try to make yourself a wish list. Grab a pen and paper, whatever, write down the currently what you want your money doing for you. What's the perfect financial vehicle, and what characteristics would it have? If you could paint your own financial vehicle, if you were Pope of money for the day, what would you want it to do? That's the sort of exercise that helped change our trajectory.
That's great. So maybe we should pivot into some of kind of the ideas you have, and we can give some hope, or better yet, agency to people who are struggling either in debt or just struggling to get started with purposeful financial planning.
Absolutely. Yeah. Take us where you want to go.
I'm just going to add also that Cecily has decided to destroy our background, unfortunately. And the good news with how we're recording this is that I believe Rory has been alternating. So the people who are watching this on YouTube are probably not seeing her crawling all over me, but the background is gone. So I hope it's not been distracting, Mark, but I've had my microphone off in the effort to talk about rocks. I actually have an analogy. Like when you throw these rocks in your backpack that you've been talking about with different financial plans and whatnot, you could have a similar backpack for just life events. And, when you throw the rock of a child in your backpack, there's an awful lot of rocks you take out, right?
That's it.
They just don't make sense anymore. They don't have meaning anymore to like your everyday, because your purpose is to raise the child, keep the child alive, healthy, learning stuff. We're grateful that she's done that. And you can hear her in the background, but
yes.
I'm going to go back on mute while you jump into Rory's question.
Oh, that's great. Thank you for that. Yeah. And I'd say sometimes when you have to take out, let's push this metaphor of rocks just a bit more, and then I'll hush. Let's imagine that your goal is to break through a window that keeps you from your destination. Let's say you really need to get through. It's a burning house. You're trying to get out of the house, and the only way out is to break through a window and smash your way to freedom and safety. Let's say in your pocket, in one pocket, you have a pound full of pebbles. Okay, a pound, full pound worth of pebbles for some reason that's in one pocket. And at first, you grab your handful of pebbles and you throw it as hard as you can at that glass window. What do you think happens? It just bounces off, right? A pound full of pebbles are so dispersed in their energy that it just bounces off. Let's say in your other pocket now, you have exactly 1 pound rock, a singular rock weighing 1 pound, same amount of weight, but now it's focused. Now the energy is exacting into the one spot you want to get to, and you throw that rock right where you need it to go, and kaboom, right? It shatters the glass and you're out free. That's the focus or the metaphor I've used personally for how I arrange my financial affairs. Sometimes diversification can feel like a bag full of rocks, of pebbles, that get you nowhere and fight with itself. I'll tell a quick story and then I'll hush. So let's say it was a few years ago now, but I met with a doctor. He made great income. And he was very proud of his mutual funds and his 401k. They had done, very good, low double digit, 12, 13% return over a couple of years' time. And he was very happy with that. Not too bad, right? But as we got into his overall financial picture, we also learned that he had a couple of mortgages on his several houses, vacation homes, et cetera, a boat loan, a couple of car loans, some old medical debt, some student loans. And he was spending a third of his income just servicing his debt. Just to service the debt was almost a third of his overall income. So we laid those two next to each other. He was wonderfully happy with his 12% in his pre-tax 401k, which after tax might be more like 8%, right? And then he had all this after-tax money getting just washed down the drain to service banks, for the privilege of staying in debt to them. He was spending a third, 30+% of his income. Now, doesn't that sound like two little pebbles that are just going to bounce off he can't break through to a goal that he might want to get to. Maybe he wants financial freedom. Maybe he wants more time with the kids, whatever it is. He won't go anywhere when he's pushing so hard on a rate of return that's not guaranteed. And yet he has all this guaranteed debt, losing a third of his income to service debt. Now, he might sound extreme, but guys, according to the U.S. Commerce Bureau, the average American spends over 34% of their income on debt. So anyway, that's an amazing fact, but it just blows me away that our money fights with itself, and that's why so many of us don't make progress.
Is the person you've been describing, is any of that being put to work for any income generating assets, or is it all just liabilities and fun life?
Now, in his case, now everyone's different, right? But in his case, it was consumer debt, but it was also personal residence debt, a vacation home, a boat, some cars. Yeah. So in his case, no, unfortunately. But I agree. I think good debt involves something that is going to net pay you some arbitrage,
Yeah, we kind of agree with that. I think that's part of the fundamentals of a lot of people that might be listening to this. Financial independence is a big movement toward, letting your money work for you and, getting cheap money because money is still relatively inexpensive these days and, going to find income generating opportunities with that money.
All right. So let's take that person right there who, might actually feel as though he's a financial success, looking at the retirement accounts and the rate of return that he's getting on there and not necessarily realizing the net effect he has. Let's put together some of the big rocks. I'm going to keep running with this metaphor just a little longer too. Let's put together some of those big rocks for him and different ways that he can either rethink his situation, or we can even get to some of the specific strategies of what he can do to bust through that window and actually make some progress.
Let's do it. I'm ready.
All right. So we have here, and forgive me if I'm kind of taking them out of order, but a couple of strategies that, you've talked about on your podcast that are relatively new to me here. So we have the concept of buying back debt. Is that something that could, well, first off, what do you mean to buy back debt, and how would it help somebody in this situation?
Rory, that's a great question. And it's great because it points to one of the biggest leverage points we have in our financial life. In fact, a lot of our listeners might have low interest debt, but it's not so much the rate that is the problem. It's the volume. It's the volume that counts, even if it is cash flowing debt. Let me kind of talk through what I mean by this, and I use the metaphor of eating. It's not so much the rate by which you eat food. It's the volume that makes you skinny or fat, right? It's the volume. So the volume of interest is what killed his financial plan. All of his debt was pretty low interest, but it was the rate. It was not the rate. It was the volume that counts. It was about a third of his income. That's the volume of debt he had, right? So in his case, what if he had followed the standard kind of like radio host advice, which was to pay cash for everything? Would he have been better off? Well, let's do the math on that. If you had bought a couple of houses, a boat, paid cash for your college education, couple of cars with cash, you'd look on paper like you had all these assets, and you'd feel so good being totally debt free. But is it really that good? No. And as a certified financial planner now, I'm saying that paying cash is also not the answer. In fact, I'd rather be an honest borrower at somebody else's bank than steal from myself by paying cash. So what do I mean by paying cash stealing? Well, the truth is, guys, you finance everything you buy. Everything you buy is financed because either you pay interest to a banker down the street, or you pay cash and you pass up interest you could have earned on that money had you left it invested instead. In fact, if you just paid cash for cars, let's say you paid 30 grand for a car and you bought 9 cars over your lifetime, you're going to need to save about $350 a month in a savings account somewhere, earning 4 or 5% if you can find one. And if you did that and paid cash for cars, you'd just have a bunch of old cars in the driveway at the end of your life, right? 9 cars sitting there rusting out. If, however, you didn't buy those 9 cars, 30 grand a piece, and you just let that money grow over your lifetime, that would be $900,000 sitting in a savings account somewhere if you just ridden shotgun and not bought those cars. So the power of paying cash is you lose opportunity growth. You have a cost to anything you buy. There's a cost to it, an opportunity cost. So what is better than being debt free? What is better than paying cash? If paying cash is not the answer, how can we do even better than paying cash? Well, buying back your debt is what I would say is better than paying cash. To your original question, Rory, the idea would be, rather than using somebody else's bank, and rather than stealing from your future self by paying cash, what if you could become your own source of financing and buy back your debt from your creditors? This is exactly what my wife and I did when it was time. We borrowed against ourselves and paid cash for the debt, wiped out all the debt. We bought back the debt from our creditors, and now we were personally the creditor to ourselves. And that's the best bank I want to bank at, is when it's the bank of Mark or the bank of Rory or the bank of Jason, right? That's the best bank to bank at, because now you're in control. You get to decide your own repayment schedule. You get to get the growth on that cash as you pay yourself back with interest. And you get to enjoy the benefits of liquid capital all along the way. And you don't break compound growth along the way too, which is maybe the most essential piece. In fact, I don't want to be too firm on this point here, but I would want to know, more importantly than your rate of return, I would want to know who's doing the banking in your life. Is it you, or is it some other banker? Because we're all in the banking business. It's just that most of us are sitting on the wrong side of the banker's desk.
Does that fall into the concept of self-banking?
It does.
So, I mean, for clarity's sake, are you actually saying that you more than just a mind shift, actually setting up loans to yourself and then paying them back as if with interest rate, with a repayment schedule, the same way you would if you were using an external lender? That's
right. Yeah. Not just a mindset, but actual strategies and systems and tactics. We need all of that to really move the needle in our financial life.
Great. And then when we talk about somebody in that situation as well, I'm imagining somebody who maxes out their retirement accounts because that's what they've been told to do, and that's kind of the simple, often right, but the simple financial advice with the purpose of just reducing taxes. Is that the right mindset, to just do whatever you can to reduce taxes, or is there a different mindset involved where maybe reducing taxes isn't the be all end all in your financial planning?
Again, there's a different discussion, and it's one that we typically have with clients, Roy. We want to discuss taxes because taxes, unfortunately, are going to be the biggest expense of our life. We'll spend more on our taxes than we will on our own children. We'll spend more on taxes than any other category in our life, which is surprising to a lot of people to hear me say that, but it's true. When we put money into a traditional 401k, IRA, et cetera, we're not actually reducing our taxes when we do that. Sure, we do reduce the tax this year, but the word is tax deferred. And a lot of people hear that word and they think tax free, but that's not the same thing as tax deferred. And if you put off something long enough, sometimes it gets better, sometimes it gets worse, and I ask our clients when we're sitting down having a meeting over the phone or over Zoom, and we're discussing kind of their overall financial picture. We're going through their concerns and what they're excited about, what their objectives are, their goals. And we look over their 401k statements, their IRAs, and I'll ask them, just up front, I'll say, hey, do you believe over the long term, I don't care, who you voted for last election. I mean, over the long term, do you believe taxes are going to be lower or higher over your entire lifetime? And guys, I don't know about you guys, but I've never heard anybody say they're going to be dramatically lower over their lifetime. It's almost always higher. And then I say, well, I noticed that you're maxing out your 401k. Well done, living within your means and being able to pack away something like that. What's your understanding of how the 401k will be taxed in the future? And they said, well, I don't know. I don't know how it'll be taxed. No one's voted on that yet, or they'll say something like that. And I'll say, well, you're exactly right. We don't know how much of that 401k you own and how much is owned by the IRS. So tax deferred can be a ticking tax time bomb, and math works out. If it's even 1% higher, if taxes are just 1% higher in the future than they are today, mathematically speaking, it's better to pay taxes on the seed now, like a Roth IRA, for example, rather than waiting to the future when we pay an unknown tax to our dear uncle.
So are there any strategies that people should consider that actually are for tax reduction, not just tax deferral? I mean, even in the real estate space, I love the 1031 exchange, but that strategy only is really truly tax elimination strategy if you carry that property until your death. Then we get a stepped-up basis, at least in the rules right now. And I know you're talking about tax rates going up in the future. I also think this tax system might be different in the future, and that's a better bet too, where you don't necessarily know where the tax burden is going to fall among the different types of investments. But are there any actual tax elimination or tax reduction strategies that work and don't just kick the can down to an uncertain future?
Man, that's the key question, isn't there? So there are strategies that help you, one, reduce your taxes, two, eliminate your taxes, which is, a different category of conversations. And again, this was some of what I put in my little checklist of what I wanted my perfect financial vehicle to have: tax reduction, tax elimination, liquid access to money, competitive rate of return, accessible, outside of the reach of creditors, lawsuits, so forth and so on, especially since I wanted to do some real estate in my portfolio. I knew the real estate attorneys would be keeping my name on speed dial if I was going to be doing real estate, because it's just a matter of when, not if. There's going to be a lawsuit, unfortunately, for most real estate investors. So I had this long list myself, and strange enough, and this shocked me because I kind of was reared on the Dave Ramsey content, but whole life insurance, of all things, does some really cool things related to self-banking and tax strategy. So I'll explain this quickly. I'll try to keep this brief, but there are at least 4 reasons why I was compelled to add whole life insurance to my own personal portfolio. And for some of our clients, it also makes great sense. So in the first, and I'll put this into TGIF just to make it real simple for all of us. TGIF, the first is tax-free. If you design the policies correctly, you can put money in after tax, kind of like a Roth IRA. The money grows in there and is not taxed every year. And then you can access that money next Tuesday or next year or 30 years from now, whenever you want it, without taxes due, if the policy was designed correctly from the start. So that's awesome if we think taxes are going to go up in the future. It's like an unlimited Roth IRA in how, you know how a Roth IRA, there's contribution limits and there's income phase outs. Well, there's none of those constrictions and restrictions on whole life insurance. It's, you can be making 10 million a year and still be putting money into whole life insurance at whatever pace you wish. So that's the first one, is tax-free. Second, it grows guaranteed. That's the G. Guaranteed growth every single year, no matter what the real estate markets are doing, no matter what the stock market is doing. Whole life insurance, if it's dividend paying whole life insurance, will grow on a predictable schedule every single year. You'll have more cash in your policy this year than you had last year and the year before. And whatever you earned last year is locked in. So, I might get a rate of return on my Coca-Cola stock and get paid a dividend on my Coca-Cola stock. But if I reinvest that dividend into Coca-Cola and then they lose share this year, they lose value this year, last year's dividend got erased off my Coca-Cola shares, right? But when I have a dividend on a whole life policy, which is not guaranteed every year, but they've paid a dividend for at least 100 years straight, the companies I'd recommend anyway, when I get that dividend, it becomes part of my guaranteed cash value forever going forward, which is really nice in terms of just building a financial projection into the future and even guarantees into the future. So, so number 2 is guarantee. Third, it is life insurance. Insurance is the I. So automatically, I'll leave my daughter more than I could ever save for her in this life insurance policy. Again, income tax free when I pass away. That death benefit's getting paid out, and there's nothing really I can do to stop it. That's just how it works. And then fourth and finally, financing is F. So again, I believe your need for financing is far greater than your need for insurance. While I use life insurance, and it's nice that it is insurance, I'm more focused on the financing piece, which is, the functionality of this policy that really compels me for real estate and how I used it to pay off all my student loans. You can borrow against the cash value of whole life insurance. And when you do that, you can access the cash value and use that money for any purpose. I used it first for paying off my student loans, but I've since used it for cars, vacations. I've used it for my business, used it to invest in some LP as an LP in some real estate syndication deals, and beyond. It'll be for my daughter's college someday, and so forth. And ultimately tax-free retirement for me and my wife. So it's used for all those purposes, but, and this is really cool, when I borrow against the life insurance cash value, if it's designed correctly, the policy will continue to grow as if I hadn't borrowed against the money. So to say that another way, let's say I've got $100,000 in cash value. And let's say I borrow $30,000 to buy a car. That year, the policy will still pay me a guaranteed interest and a dividend on the entire $100,000 as if I hadn't touched a dime of the money, as if I hadn't borrowed from the cash. And I'm driving my car around. And I get to decide what my repayment plan to myself is. Maybe I decide I want to pay $100 a month. Maybe I want to wait a year or two and then repay the loan. It's my choice because I'm in control. And when you're the banker, you get to control the entire project. So I tried to make it as short as possible. I went a little long, but any thoughts, feedback on TGIF?
My question is, when is it effectively too late for somebody? At what age is it effectively too late for somebody to opt in for whole life insurance?
Yeah, well, old-fashioned whole life insurance, the expenses increased as you aged. So the longer you waited, the more the expense. And that was typically because the focus was on the death benefit, the insurance part. And there's nothing wrong with whole life insurance specifically for estate planning and some other really cool things. But if we're using this for the cash value, not forgetting the death benefit, but if we're focused on that cash value accumulation, typically we cut the death benefit down as small as we can make it. So Rory, to answer your question, if you're still in your 80s, policies can be designed for folks even up to age 85. And because we squeeze down that death benefit, cut the commissions out, cut the insurance expense out, flood the policy with as much cash as you can, as long as you can, count your candles on your birthday cake, I guess you can be approved for this, and health-wise and so forth. Now, it's not a good fit for just anybody to go get. So I'll just briefly mention that, if you're unable to save, if you can't live within your means, I wouldn't recommend whole life insurance. It does mean you're putting money into the thing, of course. And it's not like a double-digit rate of return every year. It's going to be boring you to tears when it comes to rates of return, but it's not supposed to be an investment replacer. I think a lot of people get that mistake. It's supposed to be a cash equivalent in your portfolio that you use for other investments, for say like, real estate, et cetera.
So a very dynamic savings account.
It's very, very different from people that are into crypto and the meme stocks. They're probably not even considering having this as part of their portfolio.
Jason, you bring up a good point. Now, I will mention this. You guys might know about the kind of the dynamic between risk-free asset and risk asset. And I won't bore your audience to tears, but we actually have several episodes and a webinar we've done on how whole life insurance can be used with your cryptocurrency or any other speculative asset. Okay. So if I was to just directly invest in Dogecoin or whatever, I only have whatever Dogecoin is worth today, or Shiba coin or Bitcoin or whatever. All I have is the coin. But if I had put my money in my whole life policy first, borrowed against it, then invested, then I have two assets. I have the whole life policy and I have the crypto. Now, am I telling everyone on this podcast to do that? Of course not. but that's the power of using one asset to make two assets. What could go wrong there? Well, the crypto could crash and now you have a policy loan. Now, who has to repay that? Well, you don't have to over your lifetime. If you never pay off a policy loan, it's just deducted from your death benefit when you pass away. So instead of your family getting $1 million, they might get $900,000. I guess they'll have to struggle along on $900,000 in that case. You could also lapse the policy if you never repay it and just ignore the thing. That is very rare, but it can happen, which is why you need a good financial professional helping you out, watching the thing. But in general, you would have lost the crypto anyway, and you would have been out everything. If you didn't have the whole life policy to back that, you would have just lost all your money and had nothing. At least now, you've got a whole life policy still paying you a dividend, as if you hadn't made that mistake with the crypto. And you can pay it, maybe you pay it back over 10 years or something, and now you've made whole the policy and you've got a big fat retirement account ready to go, the whole life cash value ready to go for your needs in retirement. So is it perfect? No, but it's a pretty cool strategy for putting the money to work in the world. And maybe you're starting to see how this might fit into real estate as well.
We're not going to be able to pick your brain and get every idea out in just this one podcast episode. But for our audience in particular, I wanted to see if you could throw out any creative real estate funding ideas, because that is something that we get asked all the time. Are there any of those that you'd like to highlight for our audience?
Well, we've been focused on this one topic. And again, we are a full financial firm. So if there's other strategies that make better sense, we go in that direction with our clients. But since we've been talking about self-banking, I'll bring up whole life insurance. I do think that it's much like nitro and glycerin. When you combine whole life insurance and real estate together, it's sort of like nitro and glycerin together. They just work better together. It's like Thelma and Louise. It's like Batman and Robin. They just go great together. So when you couple a whole life policy with real estate as a funding strategy, that's a pretty cool deal. Like I bought a house in the midst of this pandemic, and I used my whole life policy as a down payment for that house. We've used the same whole life policy for syndication investments. We have clients that use their policies. I'll tell a quick story. There's a client who she flips houses, but we're talking at like multi-million level. Okay. So like very nice antique homes that go on the market for several $1 million, 5, 10 million. And what she does is she borrows significantly. She borrowed about $800,000 from one of her policies, and the money was in her bank account within about a week. No questions asked. She didn't have to get approved for the loan. There was no delay there. It just drops in the bank account. She uses that in tranches to buy and construct all the material for the renovation. And then she sells in a year or so later, right? And the house sells and she pays off that loan. Not only pays off the loan, but has profit to boot for groceries and to start new policies, et cetera.
What are the interest rates that people are paying back with these loans against the whole life policies?
Yeah, it's a great question, Jason, because nothing's free. And to make this a true loan, there must be an interest rate. In fact, that's why you can get access to the policy cash without taxes due, even on the gains. It's because there's a interest rate applied. And loans are not considered income by the IRS. That's been the case since we've had an income tax in 1913. So when you borrow against a life insurance policy, it's going to really depend on what company you work with. So I want to tell you guys and tell your listeners, really important. You want to make sure anytime you set one of these up, you work with a professional that knows what he or she is doing. I have recommended Bank on Yourself professionals for years because it's the only credential I'm aware of in the marketplace that actually puts people through a rigorous training process. As you guys might know, there's 400,000 insurance agents, life insurance agents in the United States. It's kind of like real estate agents. You don't want to just work with any of them. You want to work with the best one and one that's suited to your specialty, whatever it is you're looking for. So I would say the first thing is you want to find the right professional to build the right policy with the right company. And so, Jason, to answer your question, most of the companies, if I was to borrow from my policy and pay cash for a real estate investment and repay that loan, I'm going to say over 4 years, it's simple interest, usually at 5%. But because it's simple interest all year long, the APR, the annual percentage rate, is about 1.9% over 4 years. So it's about a 1.9% actual percentage on your loan. But realize that the policy had continued to grow on all of your cash, compounding in the middle single digit range. So how does all this shake out? It ends up where you're ahead. They call this arbitrage, right? You're ahead on that deal. It still costs you something. There's no free lunch, except on the wrong end of a mousetrap, as my friend once said. But at the end of the day, you come out net positive, where you still got more growth on your cash value than you paid in interest.
Yeah, I think in the real estate world, a lot of people are looking for cash sources. People seem to have a lot of cash these days as we record this, so they want to invest in deals, passive income. They might work full time somewhere, and they actually might want to put their money to work with an investor. But other folks are just looking to get where we ask the same 3 questions of all of our guests. The first one is very simple. If you can get on the stage and talk for 30 minutes with no preparation, not about financial planning or anything we've talked about today, like what would that be?
Oh, well, I was going to say something else, but since it's not about financial planning, because I just have such a passion for this, if it's not about financial planning, I would say, oh, hi there. Yeah, I think our teacher has appeared. So, putting the first things first in your life, and realizing that we're building all of this and doing all of this for the benefit of our next generation is just really the ultimate outcome and goal, and keeps you motivated when times get tough. So I'd focus on that if I could grab a stage and talk about anything.
That's perfect. And yes, perfect timing also, Cecily, for joining us for that. She's been around this whole episode, but I've had the microphone on mute for most of it. The second question, what's something that happened early on in your life that impacts the way that you're working today?
Yeah. I'll tell a quick story, and I'll keep it very brief, but I was 5 years old, not much older than Cecily there. And I'd accumulated some money from allowance and other things. So my mom takes me to the bank. And I had all my money, my life savings, in a paper bag in my little drawer. my little 5-year-old chest of drawers. I take my little paper bag. I dutifully follow my mom to the bank. She walks in the bank. I see this man come at me, and he asks for my paper bag so he can open up the checking account. And I did not want to give it to him. All right. Why? Well, because I believed, little 5-year-old self, that my paper bag was a safer place than keeping it at the bank. And while I understand a little bit more now, I actually think my 5-year-old self knew something that my adult self forgot, which is banks are not safe. They're not the place you want to keep all your cash. If I put $10,000 in a savings account, how much of that money is actually in their vault? Almost none of it. How much gets loaned out to the guy behind you in line? Almost all of it. And if I could set up a business that did something like that, we'd all be the wealthiest people in the world. And that's why banks have the biggest building in town. So that's my short story of, my first memory of money and banks.
I love that. I had a financial book when I was a kid, the Children's Guide to Managing Money. Still remember it. I still remember every single page of that book also.
Cool.
There was one little part of the book where it said, there are 3 things you can do with your money. It was you could buy things with your money, you could save your money, or you can give it away. And I just could not get over the give it away part. And maybe that's a little capitalist in me, but I totally get why giving it away is a good thing. But I kept asking my parents, I'm like, why would you want to give your money away? I don't get it.
I love it. That's great.
Finally, what are you listening to or watching or reading these days?
I'm reading that Walter Isaacson book on Leonardo da Vinci. He is such an awesome writer, Walter is. And then, of course, Leonardo da Vinci is such a polymath. It's just a privilege and a wonderful experience to read through this book and to see all the different ways that da Vinci was way ahead of his time and thinking different about art. I want to try my very best to help people think different about money. And to get them to become their own Da Vinci in their minds and in their financial life. So that book has been just a lot of fun. I'd recommend it to anybody.
I will have to check that one out. We don't get much beyond Mickey Mouse Clubhouse these days.
Yeah.
That's probably a good listen. So Mark, tell everybody where we could find you. We're going to put all these links in the show notes so you don't have to go through them all. But, the Lake Growth Financial Services is your company, and their podcast is the Not Your Average Financial Podcast. Very easy to find. I was finding it through Google. How else can people find you? That's
a great one. If folks want to build real wealth outside of Wall Street alongside their real estate portfolio, and you want to do it without a bunch of unnecessary risk, and you might want to look into this idea of being your own source of financing, you can go to notyouraverageFinancialPodcast.com. That's it, notyouravagefinancialpodcast.com. And click on the button that says request a meeting, and we'll chat for 15 minutes, say hello, answer any questions, and see if this or other strategies would be a good fit. Awesome. Mark, really appreciate that. And thank you for bearing with us as we stumble through our continued work from home life that we're all in. But we did have a special guest on the episode besides you and Cecily. So, this has been great. I encourage everybody to go like and subscribe and follow your podcast as well. As doing the same for the Real Estate Law Podcast. And on behalf of Cecily and Rory, I'm going to say goodbye because we're coming up to a hard stop right now. And thank you very much for listening. And we hope you'll listen to the next episode as well. Thank you, Mark. Thank you.
This has been the Real Estate Law Podcast. Because real estate is more than just pretty pictures, and law goes well beyond the paperwork and courtroom arguments. We're powered by Next Home Titletown, Greater Boston's progressive real estate brokerage. More at nexthometitletown.com. And Urban Village Legal, Massachusetts Real Estate Council, serving savvy property owners, lenders, and investors. More at urbanvillagelegal.com. Today's conversation was not legal advice, but we hope you found it entertaining and informative. Discover more at realestatelawpodcast.com. Thank you for listening.